In December 2024, Toronto City Council voted to hike property taxes on investment properties by 4%, while Montreal just announced a new municipal tax specifically targeting short-term rental units. If you own a condo in either city as an investment, your net returns just got slashed, and we're talking thousands of dollars per year. This isn't theoretical. Real investors are running the numbers right now, and some are already listing their properties. Let's break down exactly what changed, what it costs you, and why every condo owner in these cities needs to pay attention. Here's what actually happened in Toronto. On December 13th, 2024, Toronto City Council passed a budget that included a graduated property tax system. Investment properties, meaning any residential property you don't live in as your primary residence, now face a 4% tax increase on top of the standard residential rate. So if you're living in your condo, you're seeing the base increase. But if you're renting it out or it's sitting empty, you're paying significantly more. The city claims this will generate around $70 million annually to fund affordable housing initiatives. According to Mayor Olivia Chow's office, the goal is to discourage speculative ownership and free up housing supply. But investors see it differently. The Toronto Real Estate Investors Association went public immediately, calling it a cash grab that punishes small landlords while doing nothing to address housing supply. Let's talk real money. Say you own a one-bedroom condo in downtown Toronto. Average assessment value right now sits around $550,000. Under the old tax rate of roughly 0.66%, you were paying about $3,630 per year in property taxes. With the new 4% surcharge on investment properties, that jumps to approximately $3,775. That's an extra $145 annually, not catastrophic on its own. But here's the thing. Toronto property taxes have increased every single year for the past decade. Between 2023 and 2024 alone, the base rate went up 5.5%. Combine that with this new investment surcharge, and your tax bill has climbed over 9% in 1 year. For landlords operating on tight margins, especially those who bought in the last 3 years with mortgage rates above 5%, that $145 becomes the difference between breaking even and losing money every month. And it gets worse if you're holding multiple units. Own 3 condos? That's an extra $435 per year. 5 units? Over $700 annually just from this one policy change. Real estate investor Sarah Chun, who owns 4 rental condos in North York, told CBC Toronto in January 2025 that her annual costs just went up by nearly $600. She said, quote, "I'm not some corporate landlord. I'm a teacher trying to build retirement income. This makes it harder to justify holding on to these properties." Now let's move to Montreal, because this one hits even harder. In November 2024, Montreal introduced a municipal tax specifically targeting Airbnb and short-term rental operators. The tax works like this. If you're renting out a unit for less than 31 consecutive days, you now pay an annual fee of $500 per unit, plus 3.5% of your gross rental income to the city. This came after years of tension between the city and short-term rental operators. According to Ville de Montreal's Housing Committee, there were over 8,000 active short-term rental listings in the city as of mid-2024, units that could have been long-term housing for residents. The stated goal? Push investors toward long-term rentals and reduce the Airbnb inventory, choking up the housing market. But for investors who specifically bought condos in Old Montreal, Plateau, or Mile End with short-term rental income in mind, this policy just wiped out a huge chunk of their returns. Here's what that looks like in practice. Let's say you own a condo in Griffintown and you've been running it as an Airbnb. You're pulling in around $3,500 per month in gross revenue during peak months, averaging about $36,000 annually. Under the old system, you paid standard property taxes, let's say $2,400 per year, plus platform fees and cleaning costs. Now, you're paying that $500 annual licensing fee plus 3.5% of your $36,000 gross income. That's an additional $1,260 per year on top of the $500 fee. So you just added $1,760 in yearly costs. And that doesn't even include Quebec's existing accommodation tax, which is separate. Investors on forums like BiggerPockets and Red Flag Deals started sounding alarms in December. One Montreal landlord posted that his cash flow just went negative after 5 years of profitable operation. He wrote, "The math doesn't work anymore. I'm either switching to long-term or selling." And the data backs that up. According to AirDNA, a short-term rental analytics company, Montreal saw a 12% drop in active Airbnb listings between November 2024 and January 2025. Hosts are either converting to long-term rentals or exiting the market entirely. So what are investors actually doing in response? In Toronto, some landlords are absorbing the cost and passing it along to tenants through rent increases. But with Ontario's rent control laws capping annual increases at 2.5% for existing tenants, that's not always an option. Others are selling. Toronto MLS data from January 2025 shows condo listings up 18% compared to the same month in 2024. Some of that's normal seasonal variation, but real estate agents are reporting that small-scale investors are listing more frequently, citing rising costs and shrinking margins. Mark Belanger, a real estate broker in Montreal, told the Montreal Gazette in early January that he's seeing more investor-owned condos hit the market than at any point since 2022. He said the short-term rental tax was the tipping point for clients who were already on the fence. And here's the ironic part. Both cities wanted these taxes to increase housing supply and push rents down. But if investors sell to other investors or convert short-term rentals to long-term units, supply does increase. However, if they sell to owner-occupiers or if units sit vacant during listing periods, the immediate effect could actually tighten the rental market even more. Economists are split. Some argue this is exactly what cities need to cool speculative investment. Others warn that punishing small landlords won't solve the housing crisis. It'll just shift ownership without creating new units. So where does this leave us right now? As of February 2025, both tax policies are fully in effect. Toronto investors are seeing their first property tax bills under the new system, and Montreal short-term rental operators are either paying up or shutting down. The tone has shifted fast. Just 6 months ago, Toronto and Montreal were still seen as strong buy-and-hold markets for investors. Now, sentiment is cooling. A January 2025 survey by the Canadian Real Estate Association found that 34% of Ontario investors are reconsidering their portfolios due to rising municipal costs. In Quebec, that number hits 41%. Real estate investor groups are lobbying both cities to reconsider or at least phase in the increases more gradually. But so far, there's no indication either Toronto or Montreal plans to roll back these policies. And this could be just the beginning. Vancouver is reportedly looking at similar tax structures for investment properties. If other major Canadian cities follow Toronto and Montreal's lead, the entire investment model for condos could change. Here's the bottom line. If you're a condo investor in Toronto or Montreal, your returns just got squeezed. We're talking hundreds to over $1,000 per unit per year in new taxes, money that comes straight out of your cash flow. Some investors will adapt, some will sell, and some will hold on and hope the market shifts in their favor. But one thing's clear, the math that worked 2 years ago doesn't work the same way today. And if you're thinking about buying an investment condo in either city, you need to run your numbers with these new taxes baked in from day one. The market is shifting faster than anyone expected, and every investor, homeowner, and renter needs to understand what's happening right now. If this breakdown helped you make sense of the changes, hit that subscribe button. We're close to hitting 500 subs, and 99% of people watching haven't subscribed yet. Let's change that. And drop a comment below if you're a condo investor dealing with these tax hikes. I want to hear how you're adjusting your strategy. Thanks for watching. I'll see you in the next one.